Matt, you want to talk us through this?
Yeah, so I'll just talk through this is again for those who haven't seen this before, just kind of our high level earnings per share estimate. We've been using this model for several years now, and it's proven to be pretty accurate, even though it's a much more simplified version of like what James Stevens does, for example. But it's proven to be a pretty good tool. So we'll just talk through the major changes really. So we're comparing Q2 of 22 to Q3 of 22. So really, we're just looking at the most recent quarter and the projected Q3 numbers, and I'll kind of talk through what I think the big differences are going to be there. So starting with price, the big one is an increase of a little bit, about $1,500 on the Model 3 and the Model Y.
That's what we're estimating.
That's what we're estimating. Yep. And so I think when we talked about this before, Emmett, I think we were talking about like a $3,000 price increase because you had all these price increases that Tesla entered into earlier in the year. And it just takes, with like their 6-month backlog, it takes a long while for those to kind of make their way through the orders.
It's like the owner's equivalent rent. Yeah.
It's true. Yeah. So
it takes a long while to show up in the results. Anyway, go on. Yeah.
But so when we walked through this last time, we were thinking the $3,000 price increase made sense. But a couple of pieces of information we got late in the quarter. One was just kind of anecdotes, such as your own order of the Model X, which is priced about $25,000 cheaper than the current one. That was delivered in Q3. And we heard from at least one other person who had that. So it does seem that at least some amount of the much older priced at least Model X's were delivered this quarter. So that's going to have some sort of impact on the overall average selling price. And then the other thing was the Hertz order from last year. There was news at the end of the quarter that...
One quick second, just so 2 minutes ago, Elon just tweeted in response to that article we were citing earlier from that he said, no, it is not. I have spoken to Putin only once. That was about 18 months ago. The subject matter was space. So it sounds like good thing we prefaced that this is coming from Ian Bremmer, who is controversial and may or may not be trusted because apparently he cannot be trusted. Because he's the one.
Let's say bad things about Ian Bremmer now.
I know. But there's some misreporting here. Either Ian Bremmer cannot be trusted, or the reporters who are talking to Ian Bremmer cannot be trusted, and they totally misunderstood what he said. I don't know. So for whatever reason, Elon is denying talking directly to Putin before he put out his peace plan. Just so we're just putting that on the record. Anyway, sorry, I wanted to just mention.
No, I'm glad you clarified that. You don't want
or Elon clarified it.
Yeah. Okay, so what I was saying though is the price increases. It certainly seems to be the case that on the whole, a lot more of those price increases are going to hit in Q3 relative to what was delivered in Q2. But that's probably offset somewhat by the lower priced Model X deliveries that happened, as well as the Hertz orders that were, I think, at least 12 months ago, which were at the lower price. So essentially, just lowered the amount of the price increase that we're projecting comes through this quarter. So
that's pretty conservative, though. We're being conservative there. Yeah,
it is. Anyway, and at the end of this, we can go and do some sensitivities. You can run your numbers, Emmett, if you want. So then, this is just the deliveries. We've got the final numbers. So those came in there.
So what was the deliveries? It was 343,158. Because people can't see this, we're just going to say So 340,000. Everyone knows that anyway because it was reported on October 2nd. Okay.
I think I actually still have the wrong Model X number in here, but the overall number is right. So it doesn't really change the update or the figure. So FSD take rate, I'm assuming that's 7%. But I'm also assuming that there's going to be 9,000 upgrades this quarter. That could well be too high. You got to estimate something, I think, in order.
It's a conservative. Right, because we backed in 10%.
Aggressive. I don't know.
You backed in 10% for Q2, and so now we're saying it's 7%. We're estimating for Q3, right? So
So
when you backed in 10%, that was like you did some complicated math inferences to back into 10% for Q2, and so now we're saying 7% for Q3. So I think that's conservative, being a drop. I think you could say it should be the same or more, but saying it's dropped because it's being cannibalized by. Maybe the FSD
by the subscriptions. I think
enhanced autopilot
subscription. That's the big one. So, I mean, that was introduced real late in Q2. So the big assumption is that there's going to see a lot more enhanced autopilot subscriptions, which frankly don't contribute too much meaningfully. I mean, we could drop this to 0 and it would hardly move the numbers. But they will accumulate over time. And so then like 5 years from now, this should be a pretty meaningful line if a decent number subscribe to that, or if they just move up the value chain and go for the full FSD subscription instead. So but I think it's at least reasonable to assume that, you know, FSD take rate will be cannibalized a little bit. And you've also got FSD subscriptions, which I haven't changed the assumption on.
Okay.
So that gets to what I call like the pure automotive revenue. So you're just kind of multiplying all the like the hardware times the selling prices. And
That's
then to get
19 point. So people who are
yeah, sorry.
listening, that's 19.75 billion, and it was
Yep.
14.52 in Q2. So you're saying that it's going up to 19.75, the pure automotive revenue. So I'll be curious to see what our margins estimates are. Anyway, go on. Yeah, let's see.
Yep. So I won't spend too much time on this whole deferred revenue, full self-driving number here, except to say that previously, when we were going through this before, I was assuming that Tesla would recognize some of that deferred revenue. I think with some of the clarifications we got on AI Day, I'm thinking that's now much less likely. I think they'll probably recognize more of that revenue in Q4 when it truly goes to wide release. It seems like there's still several 100,000 people in North America who don't have it yet. So I'm basically assuming no change there. Then on the regulatory credit side, I'm assuming $350 million, which I think is on the conservative side. And then just a small amount of like acceleration boost and other revenue streams. So then adding in your lease revenue is calculated in a whole separate sheet. We're not going to go into that. You get $20 billion of total automotive revenue. And then I think we're going to see a pretty big boost in energy revenue this quarter. And
So
the
it was
reason for that,
866 million last quarter, and now you think it's going
yeah,
to be what?
1.1 billion, so just over
Okay.
1.1 billion. But there's been a huge amount of stationary storage deployments recently, and we know that they're really building out that capacity. Martin Viecha even said that they're not constrained anymore, cell constrained on the stationary storage side, and we know they've had this massive backlog. So to me, it stands to reason that they're going to really start ramping up stationary storage deployments in particular, and maybe a little bit more solar deployments as well. But I think stationary storage is going to be the main story to watch there. And then on the services side, I think we're gonna see another pretty significant increase there. Again, the issue coming on here is that you've got this is the second quarter now where you're going to have lease vehicles coming off of lease. So the Model 3 lease, which was introduced in Q2 of 2019, you're going to have a full quarter's worth of those leases that are now coming off
Nice.
at residual values of, like, if you look at the residual values of Model 3s from 2019 on the Tesla website, like most of them are going for over $50,000, and they're probably
Wow.
on the books for like, you know, 25,000 or something like that. So there's a really
Wow.
huge markup, and so we had we'll jump down here just a second, then we'll come back up. The services margin had historically been negative, and it jumped up to positive 56 million, which is a 3.8% gross margin in Q2.
Yeah.
That was the very first quarter that they
So
had this
how
kind of
negative
benefit.
was it? How negative was it historically? Just by contrast, do you know? Was it like negative
Um,
100 million or negative 500 million? I can't
Here,
recall.
I can unhide these. So I mean, it was like back in the day, like, you know, in 2020s,
Negative
it was like
80
minus
million.
15, 16. Oh, sorry, this
Oh,
thing is a little bit. I'll go back here, but you know, it was minus
okay.
20, you know, like minus 10 to minus 20 percent margins in the past. You know, then it like slowly whittled down in Q1 of 21 to get to, you know, like very close to zero or break even. And then in like Q4 and Q1, it was basically break even. And then you saw this jump to profitability. It was like increased 4% essentially in Q2.
Yeah.
So it's been steadily increasing, but I think the big jump that we saw in Q2 was really related to
Just the beginning of the delivery of the leases coming back and
of the
being
leases.
resold. Yeah,
Yeah.
that's
So I
big.
think that trend's going to continue to accelerate. So let me zoom back in here so it's a little bit easier to read.
It's
So then
funny.
what?
It's funny because remember we did that. Just a quick tangent. We did that Prometheus uh, virtual uh, dinner where we presented our idea of Tesla, and then in the Q&A portion, one of the other hedge fund managers who admitted he's short Tesla, and he was a smart, sophisticated guy. He asked you, I think, about the services, right? Didn't he say like,
Yeah.
don't you think Tesla is making a lot of money on service, but hiding the money they're making in service and moving it to their automotive gross margin to make the automotive gross margins look better than they are. Isn't that sort of what he asked or he suspected?
Yeah, that's what I mean. There's all these accusations that Tesla's accounting is sketchy, or like
Yeah.
they're under reserving on their warranties and that sort of thing. But I think the reality is like Tesla tries to run like the supercharger network and like the actual like servicing of the vehicles and all those things at like a modest gross margin. I think their target's like 20%. They're
Yeah.
not there yet, very clearly. But like they're expanding at such a ridiculous rate that it kind of makes sense that you're not going to be profitable on all these like new service centers and superchargers that are like just built and probably a little underutilized, or at least they just haven't reached the kind of mature level of profitability. But like all these Tesla Q guys think it's like some conspiracy that like there's like funny accounting going on, and I'm like, guys, like they've been audited for years, and like David Einhorn, I believe it was, like wrote a letter to PricewaterhouseCoopers with like very detailed,
Yeah.
very specific accusations. And it's
Yeah.
like they're aware of what these concerns are. And so I just think it's wishful thinking on Tesla Q's account to kind of just
Yeah.
hope that this is all, like a fraud essentially, and Elon's
Yeah.
going to jail. So,
Yeah,
but people still
if
think
anyone
that.
hasn't seen the Prometheus idea dinner and curious and want to see Matt kind of run circles around the talking points of like Jim Chanos and Einhorn, who basically have the assumption that Tesla is the next Enron, and they're just trying to figure out how to make that look that way. They're figuring out what suspicious ways make Tesla the next Enron in accounting scandals. That's sort of like I feel like the basis they operate under. But Matt kind of just run circles around those accusations in his accounting language with this guy, and it's really fun to watch. So I'm glad Matt was on with me, because if the guy asked me that question, I would have been like, I don't know, I have to go check with the accounting specialist and come back to you. So, but it was nice having Matt on with me to just like on the spot, just like kind of make the question look silly. Not that the guy was silly, but he's getting his talking points or his ideas obviously from people who think Tesla is the next Enron. So
Yeah. Well, I mean,
anyway,
it's kind of one of the like revolving, or not revolving, but recurring themes we have. I mean, even when we had that really great conversation with Drew Dixon, who's like reasonable as a Tesla bear, and he doesn't have a position, but he just says, at the end of the day, he's like, I don't understand their margins. Like, look at this automotive gross margin. They had like their plant shut down in Q2 for like half the quarter, and they still posted a 28% automotive gross margin, which is by far best in class. And people who've been in the industry and know that industry inside out know that that is not possible. So they're like, well, it's got to be fraud, or it's got to
yeah,
be, something.
yeah,
It's
yeah,
like, no, like they've spent
yeah,
years like destroying brain cells about like the most efficient way to do like a gigacasting, and just decide like it's like this is the
yeah,
fruit of all the hard work that they've been putting in over all those years when the stock traded sideways. And now like
yeah,
they've got a net margin which rivals Toyota's gross margin, when Toyota used to be seen as like the most profitable, like the benchmark for automotive efficiency. And Tesla just blew right by them. And people in the industry just don't understand how to process that information. It's kind of
yeah,
hilarious. So anyway,
yeah.
bit of a tangent there.
Sorry for the tangent. Yeah, sorry for the tangent. I just wanted to show some interesting tangent about that particular number, the services number, and why it's going to grow, and prove that accusation wrong. Anyway, go on. Yeah,
Yeah. So this gets to our manufacturing margin, which it was, essentially just how efficient is the manufacturing operations of Tesla. And so the way that we did this quarter, it was kind of a change from the way that we've done in the past. Essentially, we looked at all the different plants and the deliveries by quarter, and then we broke out the cost of goods sold and the average sale price for them as well. So you've got like here on the cost of goods sold, you've got in Q3 in particular, what is the cost of like the Model S and X, the 3 and Y, built in Fremont and delivered to the US or Canada or the rest of the world. And then same thing with Shanghai and Berlin and Austin. So this, just because they've got so many coming online right now, I think you really do need a more detailed kind of build up. And our main assumption here is that the cost of goods sold in Shanghai in particular was going to see a drop in Q3 relative to Q2. Primarily because Q2 was so inefficient, like the limited shifts that they were running, and just like lower throughput, the lower utilization we've seen in the past. When Tesla increases, utilization and throughput, the margins the roof. So we got this time and said, okay, well, Q1 is a really huge increase in Shanghai in particular. You saw like a roughly $4,000 per vehicle price incur cost of goods sold increase. And so essentially assuming that with the huge increase in output in Shanghai in Q3 and just being back to more normal shifts, that would come down quite substantially, but still higher than Q1. So, Q1, the Model 3 made in Shanghai for Europe cost $35,500. That's our estimate. And we're at that in Q3 will be $35,869. So just several $100s higher in Q3 to produce than it was in Q1. So that's our main assumption. And then you're coupling that with the higher average sale prices to get to essentially an automotive gross margin when you exclude like the credit revenue. So and kind of backfed it into the overall model to a core manufacturing margin of 28.8% in Q3, and that's a big deal. This is probably the single most important assumption because you're assuming over a 5% increase in gross margin just in manufacturing efficiency in Q3 relative to Q2. It's a really big assumption, and we could be off, but we went through a whole lot of detail that makes me believe that we're probably right than Wall Street on this number, but I'm curious to see what happens when they actually print results.
28.8% is the core manufacturing gross margin, right? That's what we're estimating.
Yep, that's right. And just to be clear, that's my own kind of made up the metric. Tesla doesn't report that because they don't report full self-driving, revenues and those sorts of things separately. But I think it's important to try to back those out to really get into that. So the reported gross margin that we're calculating, once you add back in full self-driving revenues and credits and the leasing revenue is part of the core manufacturing, but that gets to a total automotive gross of 32.9% versus in Q2 they were at 27.9. So
wow.
A full 5% increase Q3 over Q2, and Wall Street is certainly not expecting that. And we're going a little bit long here, so I'll try to blow through some of these other assumptions which are less meaningful. Energy, I think just with the higher utilization like we spoke about, you're going to see an increase there. So I'm assuming energy gross margins go from 6.6% to 10%. Similarly, on the services side, for the reasons we already talked about, I'm assuming that goes from 3.8% to 7%. So then you add all that together and you get total gross profit of $6.9 billion. And a total gross margin of 30%, which is, a full 5% higher than the 25% they posted in Q2. So really everything across the board.
Total gross profit. Yeah, total gross profit from 4.2 billion last quarter to almost 7 billion. That's incredible in one quarter. Wow.
Yeah, with like frankly 20,000 fewer vehicles being delivered than was expected. So that this even accounts for that. So R&D costs, I assume those will increase, but I actually think that might be an aggressive, a conservative assumption, given all the layoffs that they had. I think it's possible that the costs or the the operating expenses overall might actually decrease. But I want it to be like reasonable because they're building out so much so fast that especially with like their other operations in Austin and in Berlin. I know most of those go into cost of goods sold, but I think they're going to need more kind of global support as well. So I'm assuming this essentially stays flat, although I did reclassify something here. Don't worry too much about it, but essentially there's this restructuring charge. They had that below the line down here, but just for my own purposes, I added it up here. And then, so let's just jump to the bottom here because these other items are not too impactful. So I'm assuming total net income of 4.26 billion, which is almost a doubling of the Q2 net income.
Wow.
And that translates to a GAAP earnings per share of $1.22 and an adjusted EPS or non-GAAP EPS of $1.32. And just for comparison, Wall Street is around. Last I checked, they were like $1.05, but that was with the old delivery numbers. So I think if you update Wall Street's estimates based on the lower deliveries numbers, I'm guessing Wall Street's going to be below $1. So we're essentially projecting a pretty significant beat when Tesla reports next week. Not investment advice. I wouldn't trade on this, but I think there's strong reason to believe that there could be a pretty big beat. This is also significantly higher though than Gary Black and James Stevenson and a lot of other kind of credible Tesla analysts are projecting. So
What are they at?
Good.
Do you recall? What are they kind of?
I
What's their
think Gary
range?
was like $1.11, and I think James was somewhere in that sort of range as well. So
Mhm.
very very possible we're wrong.
Yeah, and
But I think
you should tweet. You should remind people every quarter, like around now. You should, along with retweeting this part of the dialogue, you should retweet. I know you're a humble guy, but you should retweet that chart, that infographic. I think I saw once where it shows like the dots of where you estimated versus where the street estimated versus where the actuals were, and
so.
people can understand how accurate you are that way when they see what your estimates are.
So I think this is the one that you're referring to. I
Yes.
think, right?
Yeah.
Yeah.
You need to take a screen grab of that and then tweet that along with the link for this section of our chat. I think when we post this section of our chat on the YouTube channel, so that people can kind of have some context going into your estimate, and I think that would help.
Yeah, that's probably a good idea. I mean, the thing that jumps off this graph to me is just how bad the street has been at, at
Yeah.
estimating. Like the street is just like always under. It's
Yeah.
hilarious. Like if you're a
Yeah.
good analyst, you should be missing high, you should be missing low on roughly similar bases, but or frequency. But like Wall Street is just consistently low and by a lot. I think over here
Yeah.
somewhere I actually have like the average variance. Yeah, so like the street is off by an average absolute value of 51%,
Oh
which
my
is
gosh.
like hilarious. Like they're not
Yeah.
even close. And I've missed by 18% on average.
Yeah.
And so it's just funny. And
Yeah.
I don't know everybody else's record, like
I
Gary, how
see. I see AK in the comments saying the consensus is $1.03, but the whisper is currently $1.09. I wonder where that whisper number is coming from. That's a whisper is like a number. Whisper numbers are what people use to say like, this is the number traders are whispering to each other about what they really think. About what they.
yeah.
I think that's what it's supposed to mean. But there are buy side institutions that have their own models and they actually have their own expectations, which are usually different from the consensus, quote unquote. So it's hard to gauge what that actual quote unquote whisper number is. So some I know there's some businesses that are made out of like these whisper numbers, like Estimize and stuff, try to make
Yeah.
businesses out of estimating the whisper number. But I don't know if anyone actually, if anyone in the comments knows an actual good whisper number calculation, company, I'd love to know. But you just have to kind of guess. I think what the whisper number is.
Yeah, yeah, and there's this constant issue of like analysts don't update their numbers. So like I haven't seen a lot of analysts actually update based on the actual delivery figures that were reported. Maybe they
Hmm.
have, and I just haven't seen it. But like it seems likely to me that those who do are gonna be sub $1 on average for their estimates of Q3, just based on where they were when they were
Hmm.
assuming 260 some thousand deliveries. One other thing I wanted to point out real quick. A lot of people have been talking about currency risk. Um, so I'm assuming right now that there's about a $200 million hit that Tesla takes for this. And it might it might be helpful to kind of walk through the logic on that. So
Yeah.
there's essentially no currency risk for like Shanghai delivering, domestically made
To
vehicles in the
Shanghai.
United States, or sorry, Fremont, like in Austin, delivering United States cars. There's no
Okay.
currency risk there, so you don't need to worry about that.
Okay.
Shanghai and Berlin, however, they have costs denominated in Chinese yuan and euros, obviously, and so you need to like their costs are going to be denominated in there, and then their revenues are pretty much going to be in yuan and euros also. So like essentially the way that I'm thinking about it is if you take the total number of deliveries from those factories, which I'm estimating is like about 190,000 deliveries, at an ASP of just call it $56,000, and then assume a 30% gross margin on that. That gets you to like $3.2 billion that's at risk of like currency devaluation, because your dollars and your
Wow.
costs are the same
Hmm.
there. So like I think it's important to focus on not only the revenue side but the costs.
Yep.
So then you got like gross margin of 3.2 billion if it was all denominated in dollars, let's say. And then I looked back at the historical charts for like the euro and the yen and compared like where they were in Q2 on average to where they are to the dollar on average in Q3. And it looks like there's roughly a 7% devaluation that's occurred in the quarter in the last
Hmm.
90 days. And so if you just apply, that 7% currency hit to that gross margin from those factories, you get a $232 million hit to your gross margin as
Hmm.
that gets translated back to dollars. So I added that into this other income line here. So, typically that's positive, $30 million or so. But I just added out, or I subtracted out 200 million from what that typically is to get to minus 150. So essentially, this $1.32, this pretty big beat, does include around $200 million of currency risk also.
Yeah, currency translation costs or whatever.
Yeah. Yep.